Imagine a situation where suddenly everyone decides to invest in the stock market at the same time. Office workers, students, shop owners, retirees, millions of people opening trading apps and clicking the buy button together. At first glance, this sounds like a dream scenario. More investors mean more money flowing into the market, higher prices, and faster wealth creation. But the stock market does not work in such a simple way. The idea of everyone investing at the same time reveals some very important truths about how markets actually function. The stock market is not a savings account where money just sits and grows. It is a marketplace. For every buyer, there must be a seller. This is the first reality most beginners don't realize. If everyone wants to buy and no one wants to sell, transactions cannot happen smoothly. Prices start rising rapidly because buyers are competing with each other. Demand increases sharply, supply becomes limited, and valuations stretch beyond fundamentals. In the short term, if everyone starts investing together, markets would likely rise very fast. Stock prices would move up aggressively, not because companies suddenly became better, but because too much money is chasing the same set of shares. This often leads to bubbles. History has shown this many times: dot-com bubble, housing bubble, crypto bubbles, when mass participation pushed prices far beyond real value. However, rising prices do not mean guaranteed profits. When everyone enters at the same time, many investors end up buying at high prices. Early participants may benefit, but late entrants face higher risk. The stock market rewards timing, discipline, and patience, not crowd behavior. Another important factor is expectations. When everyone believes investing is easy and profits are guaranteed, risk is ignored. People stop asking basic questions like, is this company profitable? Is this price justified? What is my downside? This mindset creates instability. Markets thrive on balance, not extremes. So while it may sound exciting if everyone starts investing together, the reality is far more complex. Markets need buyers and sellers, optimism and fear, confidence and doubt. When everyone thinks the same way at the same time, the system becomes fragile. If everyone starts investing at the same time, the most immediate impact would be on prices. Demand would rise sharply, but the number of shares available in the market does not increase instantly. Companies don't create new shares every day just because people want to buy. This imbalance pushes prices higher, sometimes very quickly. Initially, this price rise feels positive. News headlines turn optimistic. Social media fills with success stories. New investors feel smart and confident. But this is where the danger begins. Prices start moving faster than business growth. Valuations disconnect from reality. Stocks are no longer priced based on earnings or future potential, but on expectations of continuous buying. At this stage, investing slowly turns into speculation. People buy not because they believe in the company, but because they believe someone else will buy at a higher price. This greater fool theory works only as long as new money keeps coming in. The moment the flow slows down, the system becomes unstable. Another issue is liquidity. When markets rise too fast, liquidity can disappear during corrections. If everyone tries to exit at the same time, there may not be enough buyers. Prices then fall sharply. This is why markets don't crash slowly, they fall fast. Panic selling replaces confident buying. Also, not everyone invests with the same goal. Some invest for the long term, others trade for short-term profits. When prices rise quickly, traders start booking profits. Their selling meets new investors' buying, creating volatility. This tug-of-war increases uncertainty and risk. In reality, markets need diversity of opinion. Bulls and bears play equally important roles. Buyers push prices up, sellers keep prices reasonable. When everyone is on one side, markets lose balance. That imbalance eventually corrects itself, often painfully. So if everyone starts investing together, prices may rise, but risk rises even faster. The stock market is not designed to move in one direction forever. It may sound strange, but the stock market actually needs some people to not invest at any given time. This ensures balance, liquidity, and opportunity. If everyone is already invested, who will buy next? Who will provide support when prices fall? Healthy markets are driven by cycles. Money flows in, money flows out. Some people invest, some save, some spend. This movement keeps the system dynamic. When everyone invests at the same time, future demand is pulled forward. This creates artificial growth today and weaker growth tomorrow. Markets also need fear. Fear creates discounts. Fear allows disciplined investors to buy quality assets at reasonable prices. If fear disappears completely, prices become expensive and unattractive. Ironically, the best long-term opportunities appear when many people are afraid to invest, not when everyone is excited. Another overlooked point is skill difference. Not everyone understands risk management. When mass participation happens, many people enter without knowledge or preparation. They overinvest, use leverage, follow tips, and ignore downside risk. When markets correct, these investors suffer the most, often exiting permanently with losses. This is why experienced investors often become cautious when investing becomes a social trend. When taxi drivers, influencers, and neighbors all start talking about the same stocks, it signals overcrowding. Markets don't crash because of bad news, they crash because expectations become unrealistic. The stock market rewards discipline, not popularity. It doesn't care how many people participate, it cares about balance. Without sellers, buyers overpay. Without buyers, sellers panic. Stability exists only when both sides are active. So paradoxically, markets function best when not everyone invests at the same time. If everyone starts investing together and stays invested, long-term returns across the market would likely decrease. Because returns are driven by risk and opportunity. When too much money competes for the same assets, future returns get compressed. This doesn't mean investing becomes useless. It means selectivity becomes more important. Easy gains disappear. Passive strategies may deliver lower returns, while active decision-making becomes more valuable. Another long-term impact would be increased volatility. Large crowds tend to react emotionally. News, rumors, and global events would cause sharper market reactions. Prices would swing more aggressively, making it harder for unprepared investors to stay calm. Interestingly, innovation may increase. When traditional stocks become expensive, investors look elsewhere: small caps, new sectors, startups, or alternative assets. This shift can be healthy for the economy but risky for individuals who chase trends without understanding them. Over time, markets adapt. Regulations change, products evolve, and participants learn. But the basic rule remains: returns are not evenly distributed. Those who invest with patience, discipline, and understanding outperform those who follow the crowd. If everyone invests at the same time, the advantage shifts to those who think differently. Contrarian thinking becomes valuable again. The idea of everyone investing together sounds powerful, but investing is not a group activity. It is a personal decision based on goals, risk tolerance, and time horizon. Markets are competitive by nature. You are not just investing with others, you are investing against others. When everyone moves together, markets become inefficient, opportunities shrink, risks grow. Eventually, reality restores balance. Prices correct, emotions reset, and cycles continue. The stock market does not reward excitement. It rewards patience. It does not reward crowd behavior. It rewards independent thinking. Whether few people invest or many people invest, success depends on how you invest, not when everyone else does. So if you ever feel comfortable because everyone is investing, pause and think. Comfort in the market often comes before discomfort. The best investors are calm when others are fearful and cautious when others are greedy. In the end, the stock market is not about participation numbers. It is about discipline, behavior, and understanding risk. And that truth never changes.